Carl Icahn, the billionaire investor, recently gave a keynote with Forbes where he talked about his thoughts about the markets and what's coming next, and he gave a pretty strong warning about the economy.
Yeah, I think we have a real problem with the markets.
What are the problems that he's talking about? The economy, corporate America, you'll see what I mean by that in just a minute, and inflation. Let's talk about what he said about inflation.
To begin with, we're trapped with this inflation. Inflation is a terrible thing.
He calls the money printing that the Federal Reserve Bank has been doing a drug, and now our country has become addicted to this type of money printing, but now we have to pay the price for that. That price is inflation, and inflation is hurting everybody across America because now the cost of things are growing so quickly, it's become hard for people to afford their basic necessities, let alone go out and start spending money on nice things. So now we have to fight inflation. And this fight on inflation has a price because you have to keep raising interest rates, and raising interest rates has a cost because it makes asset prices, stock prices, house prices fall. But Carl says that it's better for us to face a recession than it is to face a currency crisis.
Powell is very right to do anything he can to stop this inflation that's coming on.
Now, this inflation problem should be pretty obvious. I've been talking about it for a long time on my channel, but the thing that I haven't talked about is the corporate America problem that Carl Icahn talks about. So watch this 20-second clip from Carl, and then I'll explain what he means.
The CEOs, rubber stamp boards, and the money has been very cheap. So they've been able to borrow money very cheaply. But instead of putting it back into production, they've taken that money, borrowed more and more, and bought stocks at very high valuations.
Imagine this. You are the CEO of this corporation, and right now your stock is selling for $100 a share. Well, you were looking at your investment opportunities, and you have this cash in the bank, and you have all these assets that your business owns, and you say, well, we can go out and borrow money at 3%, maybe 3.5%, maybe 4%. How about we go to the bank, we borrow $500 million, and then we go out and instead of investing this money back into the corporation, we use this cash to buy up more shares of our stock. And this is what many corporations did. So now you go out and borrow $500 million at a very low interest rate, you buy up the stock, and now the stock price goes to $106. You're paying 3 to 4% in interest, but you just grew your investment value by 6%. So it's profitable. Everybody's making a ton of money. But the problem now is all these corporations have borrowed insane amount of money, not to grow the company, but to then increase their stock valuations. And now these corporations are left with all this debt on their balance sheet, and the interest rates on this debt is rising because many times this isn't like a 30-year fixed rate mortgage. These are variable interest rates. These are debts that have a short fixed term loan, so they readjust every couple of years. And so now corporations have all this debt burden, and now they have this high stock price, which means that investors are going to expect higher earnings, higher profits, higher revenues in order to justify these higher stock prices. And if a corporation now is going to spend more and more money, not to grow the company, but to just pay off this debt, well, now they have less money to invest in growth, to invest in machinery, to invest in innovation, and to keep paying their employees. This is the corporate debt problem that Carl Icahn is talking about, that he says that we're going to face in the coming years. Now, to put it in perspective, this isn't really a problem that was created in 2022. This is a problem that was created in 2021, because in 2021, we saw a record amount of stock buybacks happen. In the third quarter of 2021, there was $234 billion worth of stock buybacks that happened in just one quarter. So we're talking about hundreds of billions of dollars worth of stock buybacks that happened in the year 2021. Why? Because interest rates were dirt cheap. So these corporations said, well, how about we just go out and buy up as much of our stock as possible by borrowing money for super cheap, by then making our stock prices go up, because now you pay 3 to 4%, but you just made a 6% return. So it's an easy way to make quick profits on your debt. But now what's happening is that this interest rate is rising, and now the cost of servicing this debt is going up. And so I did a little bit of digging to see how much of this debt is actually fixed rate versus variable debt. This 2017 study from the Federal Reserve Bank says that about 85% of corporate loans are variable interest rate debt. This is the dilemma that corporations are facing now because the Federal Reserve Bank is working to raise interest rates to fight inflation. Now, these interest rates are not 3 to 4%, they're 7 to 8%, even 10% for corporations because you have to pay a premium than what you're going to pay for your 30-year fixed rate mortgage. So now corporations have this much higher debt that they have to pay to service all this money, and now instead of having money to grow the business or keep hiring more employees or even keep their current employees, they have more and more dollars going to pay off their debt while the Federal Reserve Bank is working to raise interest rates, while investors are going to be looking at their future earnings saying, wait, your stock price is way up here, but you're not getting the profits or the revenue that we would expect, which is putting a lot of downward pressure on stocks. And this is creating a corporate debt crisis that we might be facing in 2023, especially if interest rates continue to rise. This is the warning that Carl Icahn is saying for corporations, and this also creates some opportunity, which I'll get to after I talk about number 3. Now, if you do want to stay up to date on what's happening with things like this, well, you can join Market Briefs. It is a completely free resource that I created to help investors stay up to date on what's happening in the financial markets. It's an email breakdown of things that's happening in the stock market, the real estate market, crypto, inflation, and the global economy. It's completely free. It's a fun breakdown, and you can read it in less than 5 minutes every morning. Even if you don't have a financial background, not only will you understand what's happening, but you're going to look forward to reading Market Briefs every morning. So if you want to join Market Briefs for free, I'll put the link to how you can join down in the description below. So now we talked about inflation, we talked about the corporate debt problem. The third thing that Carl Icahn highlighted is the economy, but not in the traditional way. Take a listen.
I would say median household net worth is really non-existent.
What he's saying is that right now, about half of America has no net worth. It is virtually non-existent. The other half, minus the top 10%, are looking at their net worth and they're saying, well, I'm worried about my stock portfolio and I'm worried about my housing price. And because now people are worried about this limited net worth that they have, they are now being much more cautious with their money, meaning they're not spending their money. Now, from a personal standpoint, this is good news that people are not spending because hopefully that means that you're spending more money to actually invest, you're putting aside money for your savings, you're using your cash to pay down some of your debt. On that side, if that's what's happening, that's good news from an individual level. But if we take a step back and look at it from an economic level, well, our economy runs on spending, which means if people are not spending money, Chipotle is not making money. Amazon's not making money. Lululemon's not making money. Apple's not making money. And if these corporations are not making money, well, now they're going to struggle to continue to invest in their company, and they're going to struggle to continue hiring more employees, and they're going to continue struggling to keep the employees that they also have. Now, this doesn't mean that it's your American duty to go out and be broke and live in debt just to keep supporting these corporations. What this means is now looking for the opportunity. And what Carl Icahn says that he's doing is he is looking for what he calls hidden jewels. He's looking for companies that are mismanaged, that have too much debt, that have good companies, have good products that can be turned around. Now, of course, he has a little bit of an advantage because he is investing with billions and billions of dollars. And when he invests in a company, he likes to actually take over the company, meaning he will come in, buy a big piece of the company, he might fire the CEO, he might change up the board and change the way the company is run. That way then he could come in and actually turn a company around or flip it for a quick profit. If you want to learn more about what Carl Icahn does, because he does like this thing called corporate rating, that was how he became very successful and very wealthy by taking over companies and selling off their assets or completely turning the company around. I mean, just a lot of interesting things. Some people called it immoral, some people called it very good. It really doesn't matter what you think of it. If you want to understand what he did, check out his book, King Icahn, to understand how he built his wealth by taking over companies in that way. It'll help you understand how this type of investing works in a different way of actually valuing companies. But the reality here is now, if you don't have billions of dollars to invest, how can you now find the opportunity? Well, just like what we've been talking about for years now, there's a couple things you got to understand. One, you got to be educated, meaning know what it is that you want to invest in. Are you going to put your money in stocks? Do you want to put your money in real estate? Do you want to do both? Start with one, that way you know what you're doing. Look for opportunities then. Where is the opportunity going to be? What type of companies do you want to invest in? Do you just want a dollar cost average and not have to worry about it? If so, then don't worry about everything else. Just put your money into the market every week and never think about it. You don't turn that off, you don't change it. This happens whether the market is up or down. If you want to be more involved, now start researching companies. Start learning about how do you value a company? How do you find a good company? Then when you find a good buying point, that's when you start buying. You don't gotta buy all at once, you can buy in phases, and then you gotta have the cash to actually invest. How do you get that cash? Well, you can earn more and you can spend less. You create this margin so you have cash to actually go out and take advantage of these opportunities, because the people that become wealthy in these sorts of economic swings are not the people that just sit there and watch it happen. It's not the people that sit there and get burned by what's happening. It's the people who are prepared to take advantage of opportunities when they come your way. Right now, interest rates have doubled, more than doubled, since the beginning part of 2022. And the real effects or the pains of the interest rate hikes that we've been seeing over the last 6 to 9 months haven't really been felt yet in the broader economy, because the people that are feeling the pain of the higher interest rates today are the people looking to get new loans,